I'm going to tell you the FTSE 100 growth stock that I'm buying in July 2020 so that you could possibly beat the market. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please seek a licensed professional. Technology stocks are actually the best performing stocks of the last decade, vastly outperforming that of many of the other sectors. So it really should be no surprise that when looking for capital growth, you would be looking at technology stocks. They can return the highest capital appreciation, and at a young age, it is wise to increase the amount of risk in order to compound your growth early and increase your overall net worth. And it's wise to look at these higher risk / higher reward stocks in order to do so. So that's what I'm looking at today. So I've been looking at high growth potential, but also paying a dividend, because we can't forget dividends here, and overall they will help compound your overall portfolio. And at the end of the day, I don't plan on selling these stocks, and in fact holding them for life so that I have got a dividend income in the future. So once the capital growth does slow down, even if it continues to outperform the market, I will still have a steady, stable dividend income waiting. Halma provides technology solutions for safety, health in environmental environments. I'm not sure I meant to write that. HLMA is currently trading at a price to earnings ratio of 47.9 times, which is more than 3 times higher than that of its industry of 15.3 times, suggesting that this stock is severely overvalued, but also means that investor sentiment is actually quite high, and the investors that buy this stock don't mind that they are paying a premium and paying for less earnings, as they believe that this stock will continue to outperform that of its competitors in the industry and also outperform the market. This can also be confirmed by looking at HLMA's price to book ratio, and currently they're trading at 8.2 times, which is extremely high, suggesting that their market capitalization divided by their net assets is way higher than that of its industry of 2.2 times and a market of 1.3 times, which does mean this stock is very overvalued, but doesn't necessarily mean that this won't continue to perform and provide you great future returns. With that in mind, that does strike out the idea of this being a value stock, as it is completely overvalued. Halma have a dividend yield of 0.71% and a dividend frequency of biannually, typically paying in August and February each year. Currently, HLMA has a payout ratio of 34%, which is brilliant. It means that they can reinvest most of their earnings back into the business so that they can acquire other businesses and continue to grow. But it also means that they have got plenty of room to continue growing their dividend in the future should they want to. And in the last 20 years, they've not only managed to consistently pay a dividend, but grow it each and every year, which is impressive. And in the last 10 years, you would have seen a compound annual growth rate of their dividend by 7.15%, which beats that of the target for inflation by around 3.5 times, and should not be looked at lightly. When looking at consistent dividend growth, this is such a great amount to have, as you know that reliably each year they're going to grow it by around 7%. Whilst this is a boring and slow company in terms of dividends, especially with a lower yield, this might be what you want. It's a more defensive, lower risk stock to buy for dividend income. And you know at least then in a recession that you will be being paid income. 60% of you watching this video right now aren't subscribed. So if you're interested in my UK weekly portfolio updates and my monthly UK stock picks, then please consider subscribing. Thank you. However, where Halma really excels is its capital appreciation and its return on assets and the potential growth from this. Whilst in the last 5 years they've managed to grow their earnings by 12.6%, that was beaten by the market of 13%. With that in mind, Halma do have a high return on equity of actually 16.9%, which is how well the management are able to generate profits using the shareholders' money. And this is an impressive figure to see, considering it beats that of its industry of only 9%. This is also seen by their impressive return on assets, in which they have 10.9% versus that of the industry of 6.9%. Once again showing that they are able to outperform that of its industry and subsequently the market. And if their share price reflects the rate at which they are generating profits from returns on assets, capital employed and equity, you could likely see this reflected in the share price of the stock, and therefore in the future it's very likely that you could see this generate higher capital appreciation than that of other stocks in its industry and the market. This is all whilst Halma is a low-risk, reliable defensive stock, as they have an outstanding financial position in which their short-term assets outweigh their short-term liabilities, and also their short-term assets outweigh their long-term liabilities. Whilst these liabilities can't be combined and then outweighed by short-term assets, it's still an extremely strong position to be in. They already had a fairly low debt to equity ratio of around 36%, but over the last 5 years, they've managed to lower it to 31%, showing that they don't need to over leverage their company in order to generate impressive returns. It is worth noting that analysts are fairly bearish on this stock, and they don't believe that this will continue to grow at the rate at which it has. And you can see this in earnings per share forecasts, which are to slow down, and earnings and revenue growth as a whole. In the time period of 5 years in which the market had returned 15.4% with dividends reinvested, Halma managed to smash that out of the park with around 214.6%, beating that of its industry of 107.6% by more than double, whilst maintaining a lower beta volatility, meaning that it won't drop as far as the market or grow as far as the market, of 0.52, which is less than its industry of 0.68 and the market of 1. Low risk, high reward, which suggests once more that this is a low risk defensive growth stock that also pays a consistent dividend and would be a staple in any portfolio. Also, being in the technology sector, UK listed, does provide some promising returns in the future. I'm going to keep buying this stock, even though Halma is up 6% year to date. I'm going to personally set a price target of around 2,300 pence, but I'm happy to consistently average into this stock each and every month, regardless of what its overall valuations are, because I believe in the company and its future. If you're interested in stocks to buy, if there's a second wave of the pandemic, then please click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. See you Thursday at 4 PM, hopefully with a fresh haircut. Goodbye.